Welcome everyone to a new video on ratios. In the previous video, we discussed about the profitability ratios and the category of profitability ratios which is known as overall profitability ratios. Today, we'll discuss another category of ratios which is known as turnover ratios. Turnover ratios are also known as activity ratios or efficiency ratios. It is known as efficiency ratios because it measures how efficiently the assets are employed in a firm. So this turnover ratio highlights upon the activity and also the operational efficiency of the business concern. That means it measures how efficiently the assets are employed by the firm. So this ratios indicate the speed with which assets are being converted into sales. The assets can be either stock, it can be either debtors, etc. So the speed with which the assets are being converted into sales is indicated under this turnover ratios. So in turnover ratios, we have different types of ratios and its calculation. We'll see one by one in the coming slides. So these are the different types of turnover ratios that we need to learn. Stock turnover ratio, fixed assets turnover ratio, working capital turnover ratio, the debtors turnover ratio, and the creditors turnover ratio. So we'll start with stock turnover ratio. Stock turnover ratio is also known as inventory turnover ratio, or it can again be known as stock velocity. So this particular ratio indicates whether the investment in inventory is efficiently used or not. So therefore it explains whether investment in inventories is within proper limits or not. It also indicates or it also measures the effectiveness of the firm's sales efforts. So if the sales efforts are good and up to the mark in case of a firm, the stock turnover ratio will be better. So let's see how stock turnover ratio is calculated. It is equal to cost of revenue from operations divided by average inventory. So as you know, cost of revenue from operations is also known as cost of goods sold. So how to calculate that particular item? So cost of goods sold is equal to sales minus gross profit, or it can be calculated as opening stock plus purchases plus direct expenses minus closing stock. We will get cost of goods sold or cost of revenue from operations. And the second item is average inventory. So we know that when average, how to calculate it? Opening stock plus closing stock by 2. Opening inventory plus closing inventory by 2. So this is known as stock turnover ratio. Regarding the stock turnover ratio, it also signifies the liquidity of the inventory. That means the speed with which inventory can be converted into sales. That is liquidity of the inventory. So when it is a high turnover ratio or high inventory turnover ratio, it shows that or it means that there is a brisk sale happening in the firm. Brisk sales are happening. That means the sale is happening very fast. If it is a lower ratio, it indicates that the sales are not fast enough, which indicates there are blocking of funds in inventory. That means the firm is not able to sell the inventory very fast. So in this point of view, we have to consider one more calculation, that is the stock holding period. What is the period of time? Or it is also known as inventory holding period or stock realization period. So it can be calculated as number of days in a year or number of months in a year divided by stock turnover ratio. So that gives the stock holding period of a firm. So in case of stock turnover ratio, there is no standard ratio for the comparison. Okay, so each field and each kind of business has its own standard. So that's all about stock turnover ratio, which indicates whether an investment in inventory is efficiently used or not. Okay. The second one is fixed assets turnover ratio. Fixed assets turnover ratio. So this particular ratio indicates the extent to which investments in fixed assets contribute towards sales. So how much does the investment in fixed assets contribute towards the sale? So that is the point of question or point of discussion in case of fixed assets turnover ratio. So if we compare with the previous year, it indicates whether the investment in fixed assets has been judicious or not when it comes for comparison. So we can calculate the ratio as net revenue from operations or net sales divided by fixed assets. So I hope both the items in the equation is already known to you. Okay, so that's all about fixed assets turnover ratio. So it indicates the extent to which the investments in fixed assets contribute towards sales. Third one is working capital turnover ratio. So working capital turnover ratio reflects the turnover of the firm's net working capital in the course of the year. So the idea regarding the firm's net working capital can be reflected in working capital turnover ratio. So it is a good measure of over trading and under trading. So please note that point, over trading and under trading. So let's say the calculation is equal to net revenue from operations or net sales divided by net working capital. So you are aware about net revenue from operations. So what is net working capital? As you know, net working capital is the difference between current assets and current liabilities. So current assets minus current liabilities gives the net working capital, which is very simple. Okay. Next one we have a debtors turnover ratio, which is one of the most important turnover ratios. So in this point or in this category, we can discuss about the debtors velocity also. So first we will see what is debtors turnover ratio. So debtors turnover ratio, it discusses the credit collection power and policy of the firm. Credit collection power. So how or what is the policy of the firm regarding the credit collection? That has been discussed in debtors turnover ratio. So here there is a relationship between the accounts receivables and the net credit sales of the period. Accounts receivables and net credit sales, since it is debtors. So accounts receivable may include the debtors, the bills receivables, etc. So if the debtors turnover ratio is higher, that is better for the firm because it indicates the efficiency of the staff who are entrusted with the collection of book debts. So when the ratio is higher, it means that there is efficiency in the collection of book debts. Okay, that means the debts are collected very fastly and promptly. So let's see the calculation. Debtors turnover ratio is equal to credit revenue from operations or credit sales divided by average debtors and bills receivable. So please take a note that here we consider only the credit sales for the case of debtors turnover ratio. So now let's say what is average debtors and bills receivable. So average debtors and bills receivable means it is equal to the opening debtors and bills receivable plus closing debtors and bills receivable divided by 2. So if the opening debtors are not given, we'll take the closing debtors as the average debtors and bills receivable. Okay. Now let's come to one of the most important point in relation to the debtors turnover ratio, which is known as the average debt collection period. So what is the length of or what is the length of time or what is the average number of days that is between the receipt of invoice by the customers and the actual payment of invoice? That particular component is considered under average debt collection period. So it shows the average number of days that elapsed between the receipt of the invoice by the customers and the actual payment of the invoice. So maybe the customers get the invoice on 2nd of July and they make the payment, they make the actual payment on maybe 5th of September. So the number of days or the number of months between these two dates, that is known as average debt collection period. So it shows the length of time during which the firm is financing the accounts receivables. That means when a firm has a debtor, the firm's fund is blocked in that debtor if it is not converted fastly. So in that point of time, maybe 2 months of average collection period. So there is a lag of 2 months to collect the debt back from that particular person. So for that particular time period, for that particular 2 months, how the firm is managing or how the firm is financing the accounts receivable, that is also considered here. That concept is also considered here. So that means that it shows the length of time during which the firm is financing the accounts receivables either with own funds or with borrowed funds. So when they are not able to get the money from the debtor, or when they're not able to receive the money from the debtor, they'll go for another sources from where they can get money so that they can continue the operations of the firm. Okay, so if the average debt collection period is shorter, it means that the debtors are making prompt payment. Or if it is longer, it means that there is inefficient credit collection performance. So this is the significance of average debt collection period. So now let's see how to calculate it. Average debt collection period is equal to number of days in a year. That means it can be 365 or month. It can be 12 months divided by debtors turnover ratio. It depends upon the information given in the question. Okay. So I hope that is clear to you. And also remember this average debt collection period measures the quality of the debtors also. Okay, so it reduces the chance of bad debts. Now we have the creditors turnover ratio along with the creditors velocity or the average debt payment period. Okay, so first let's see what is creditors turnover ratio. So it means the number of times the accounts payable rotate in a year. Number of times the accounts payable rotate in a year. That means it signifies the credit period which is enjoyed by the firm in paying its creditors. So the firm has also borrowed some money from some persons. So the firm becomes creditor. So this creditors turnover ratio, the creditors velocity, shows or signifies the credit period which is enjoyed by the firm in paying its creditors. Okay. So here it shows the relationship between net credit purchases and accounts payable. So earlier it was accounts receivables and net credit sales. Here it is accounts payables and net credit purchases. Okay, so let's see how to calculate it. Net credit purchases divided by average of creditors and bills payable. So average of creditors and bills payable can be the opening creditors and bills payable plus closing creditors and bills payable divided by 2. If opening creditors is not given, then we'll take closing creditors and bills payable as the average creditors. Okay. And now what is average debt payment period? It is the number of days the firm takes to repay that particular amount to the creditor. Okay, so it indicates the promptness in making payment of credit purchases. Promptness in making payment. In case of a debt collection period, it was promptness in collection. Here it is making payment. And it also enhances the credit worthiness of the company. Okay. So one thing that you have to remember here is if cash purchase is not specifically given, the given purchase may be taken as the credit purchase. And if bills payable amount is not given, the account payable means creditors. Okay, so these are the points that you need to note down. So these are the different turnover ratios and the different category of ratios and its calculation and significance. Hope you have understood. Go through the video again, understand the concept. Thank you.